There are three distinct strategies employed by investors when committing capital to markets: pots, buckets and bridges. Each of these treat capital required for income very differently. Is there a right and wrong answer? Tonight we attempt to answer these questions. And gentlemen, welcome to the program. Kobie, I think you should start off by talking to us about what pots, buckets and bridges are. Given the fact that it's your creation, tell me how you created these.
Okay, well, I'm going to tell you about this creation just now because there's a bit of a story behind this creation. But, often we talk about equities and bonds and cash and asset allocation and everything. So this time around, something slightly different. And I think there's some other show that's maybe taken that line. Just look at your screen there quickly. You'll see an explanation of what pots, buckets and bridges are about. So when you invest your money and you decide to put it all into one product or one portfolio, that's what's called a pot. 100% of your capital is employed in a single portfolio of assets. A bucket is when portions of capital is tied to various portfolios, but now with different risks depending when the investor requires the capital. So in essence, what you do here is that you would probably tie your money into something that's less volatile over money that you need over the short term, but something that's a lot more volatile for money that you might need over the long term. And then bridges is where your first couple of years or your first year's worth of income is left in cash. Now, let me just show you an example of what that would look like. If you invested in a pot, there you go. That's what it'll look like. Well, you start investing, you have the downward cycles, you have the upward cycles, more down, more up, and so forth, and that's how it looks over time. Once you use a bucket strategy, well, there you go. That's what it looks like. Over 0 to 2 years, the capital that you might need is actually in a portfolio that isn't really volatile. It might be cash. It might be something that, say, matches inflation or something with a very low growth rate. Money that you need over 2 to 5 years is slightly more volatile than that, as you can see there. And money that you need over the long term, over more than 5 years, you can see that's invested in something that's a lot more volatile. And then if you bridge your money or you use bridges, you see that you make use of cash for kind of 0 to 2 years or money that you need to live off for the very beginning part of your retirement. And the rest of it is invested in what we call a core strategy. And that might very, very well look like something that's kind of pot related.
Pots look great.
You like pot? Well, maybe.
High risk. I'm just looking at the returns. But if 100% of your capital is in a single portfolio, you're not diversifying your risk, are you?
Well, it depends what that portfolio is.
Yeah.
If it's a balanced strategy or an inflation-linked or targeted kind of strategy, it could be a lower risk than a full equity strategy.
Well, let's add one or two thoughts to that, because when I'm going to retire, we mentioned the retirement example earlier on, I will have probably on average about a balanced type strategy. So I'll have different asset classes in there. I'll have probably about 60% equities, etc. What investors often don't realize is they think, well, balance sounds safe. So I'm absolutely okay and I don't need to worry. But a typical balanced portfolio, in any given 1 year period, can suffer loss in bad markets of 15 to 18%. Now, if I'm going to start drawing down an income on this portfolio as well, of let's say, worst case scenario, 10%, 12%, suddenly I can wipe out a quarter of my capital through the course of the first year. And it's for this reason that a great many investors that arrive at that point where they are going to start drawing capital off their income portfolios really try and consider alternative measures that they could employ in case the market should go pear-shaped over the next few years.
Maybe a question just for Henry. Henry, when you look at the financial planning industry in South Africa, is there commonly held beliefs? So if you walk into a certain planning outfit and you say, look, here's my 5 million or my 3 million or how much ever money you have, what should I do? So the answer that you'll get, pots, buckets and bridges is maybe different from a different financial planning outfit that you'd potentially walk into. Does that happen in the industry?
Certainly in the upper end of the industry, Kobie. If I'm going to look at most people going through that retirement investment decision-making process, if you're fortunate and you qualify as a potential client of one of these niche wealth management businesses that invest 7 million rand upwards, typically what we find with a lot of these businesses is that they tend to favor a bucket-like strategy in what they do. So they're going to say, okay, fine, let's look at the money that you need over the first 2 years, put it in a cash hybrid, so sort of years 3 to 5 and something moderate, and sort of long-term and something more growth-geared. What's interesting with some of these businesses is it implies a number of things. Firstly, the more money you've got, the more aggressively your money will be invested. The more growth you're going to get, which is awesome for the investment company if their primary source of income is performance fees. Just a thought. So what that means in the alternative is if I don't happen to have 7 or 8 or 10 million rand and I walk into a business like this and let's say I've got only 5 million rand, proportionally, a great deal more of my assets will be invested in cash and a conservative portfolio. So what happens? I get less growth over time because I've got less growth asset exposure. And essentially, the people that need the growth end up not getting it. The people that don't need the growth and can invest much more based on what their risk tolerance is end up getting most risk.
I mean, you see, there's a whole emotional thing happening here. Imagine you walk into an asset management outfit and you say, look, here's my money, I'd like to invest. And I say, okay, I'll tell you what, let's take all your money and put it into equities. You'd probably look at them and say, I'm sorry, I mean, isn't there risk associated with that kind of stuff, And you'd probably say, well, yes, but I mean, long term it'll be fine. Don't worry about it, And you'll say, no. I mean, this is my life savings, I mean, this is quite, this is very scary. So you can see why buckets, and this is just kind of reiterating what you said just now, that why buckets are so important, or why people use buckets. It's because you could say to the individual, look, we're going to put your money in equities, but a lot of other money that you're going to need in the kind of beginning phases of your retirement, we're going to use in other asset classes. So, it kind of takes a volatility away. And you can see it's a lot more approachable for the mind to kind of think about that.
Obviously, Roland, this is a philosophy that we seem to be more comfortable with from an emotional perspective. This whole diversification issue.
The issue, or the question maybe again to the panel is, surely there's another way to do this, and that is to explicitly manage the risk. So I'm asking whether, in order to sleep better, we take the initial risk decision right out of the equation by buying something like a capital guarantee. Because what you are doing there is you can have it invested in a high risk asset, but there is no downside. And there are cheap forms of capital guarantees, and there are more expensive forms. So one has to obviously weigh that up. But what is wrong with paying away some of the upside to protect my downside in the interim? Because this is your largest financial asset that you are going to live off for the rest of your life. You're happy to insure your car and your house, but you're not happy to insure.
So buy protection, basically.
Yeah, you buy protection. What's wrong with that kind of strategy?
Are you thinking of buying protection for the entire investment, for the entire investment period, or only a portion thereof?
Well, good question. So maybe initially
You're talking about pots specifically at this stage.
I'm actually talking more about a bridge. So you're trying to, in the first few years, make sure that you're not going to lose any money. So you're in the market early, but you're not going to lose any money. So over time, that base is set. And yes, you will have to pay away, if the market runs in that early period, you have to pay away some of that upside to protect your downside. That's how derivatives sort of work. And then after that, you can go into, or for longer periods, investment periods, you can go into a slightly riskier strategy without that downside protection. You
raise one or two exceptionally interesting points. The first one is, quite rightly so, how do I protect myself most effectively against risk? How do most of us define risk? Well, we define it as how big is my chance of losing money. The bigger my chance of losing money, the higher my perceived risk is. And a lot of us, when we make our first mistake, is we tend to measure risk on a year-to-year basis. So although I retired with 5 million rand and 10 years later, I may have 8 million rand. If I was drawing an income and my 8 million was worth 7.7 the next year, I'll think, boy, I suffered a loss. We forget to measure against where we started, and we tend to be very short-sighted, very myopic in terms of measuring those losses. I promise I'm answering your question in a bit of a roundabout way, but let's understand that as background. Point number one. So if I'm going to look at overall minimizing the chances of realizing a loss from my pot of money the day that I retire, I need to understand that I need to measure those losses not against what my values are from year to year, but against where I started. And that means that if I look, for example, at equities as an asset class, over a rolling 8 to 10 year period, historically, equities almost never gave you a negative return. Okay. So now, mitigating that risk, trying to deal with not suffering a loss, becomes much more about the point you just made.
In the short term.
How do I deal with that short-term loss until the kicker behind my equities? And
what if you got your lump sum payout in March 2008, and you didn't protect yourself? You would have taken the full brunt of the subprime crisis, and then you'd had a lower base to grow after that if you didn't protect up front, right?
Let's answer that question by using a real life example. Now, you might not think so, but aesthetically she doesn't look like it, but she is retiring. Eleni is retiring. She's 60 years of age. Eleni, I never knew it. I never knew it. Now, she's got about 6 million rand in savings, and she needs an income of 25,000 rand per month. That's about 5% of her
31
capital.
years to go, by the way, before I turn 60, just to
How many
clarify.
handbags and shoes
Thank
is
you.
that?
Thank you for being so honest about your age, Eleni, on live TV. Now, let's just take as an example. Eleni is going to draw down about 5% of her capital. And that, in essence, means that she's drawing down below the inflation rate in South Africa. 6 million. 25,000 rand per month. I hope she can keep herself in the way in which she's become accustomed to. Now, Eleni, let's choose one. Pots, buckets, or bridges? What do you choose? You're the
Pots.
client.
Pots.
You want to go pots?
Let's go pots
Okay, you want to
first.
go pots. So which in essence means Eleni is now investing all of her capital up front right in the beginning. Now, if you just look at your screen there, you'll see what the research shows. Here's Eleni's age, all the way from 60, and if she can make it 120 on the other side of the equation over there, which means she's just basically started living at the age of 60. How's it invested? The pot total capital is invested in what we call a moderate portfolio, about 40 to 50% in equities. And the bridging strategy, how's that invested? Well, the capital in the first year is in cash, and the rest is again in that moderate portfolio I spoke about. And you can see the two results are actually quite similar. Look at that. The two lines actually run through time quite similar. Eleni will run out of money basically at the age of 100. So unless she plans to live much longer than that, that's kind of the point where she's going to be. If she decided to go the bucket strategy, and again here, the short-term needs are in cash. Your capital needs for the next 2 years is in a conservative portfolio, and that would be below 40% in equities, and the rest is in a moderate portfolio. So we're not exposing you to any massive amount of risk. Let's see when the capital runs out. Well,
Look at that,
basically,
92.
age of 92.
I do plan to live above 92, by
Do you?
the
Do
way.
you?
I
Well,
absolutely do.
Eleni, let me put those two graphs together for you, and then you can have a look at it. Now, you can decide when you want to die, which unfortunately is not up to you. And I mean, there you can see it now. And now what we've done is, it's a linear exercise. We've taken average returns in the markets into consideration. Obviously, if you take real returns in markets into consideration, despite the volatility, you could probably add some numbers to these numbers as well. Startling, Henry, these numbers.
How realistic are these numbers, actually? It's great to look at these graphs. Should I ask you, actually, how realistic are these,
Well,
these graphs?
I was just thinking, how much money would you want to leave for your children as well?
This
You've
is
got to
what I
take that
wanted to
into
say. I
account.
have to leave a legacy behind.
Well, that in itself is an interesting question, but maybe more than we have time for now. Let's look at how realistic these numbers are, and let's perhaps clarify one or two of the assumptions as we go along and in explaining these a bit better. Right here we're looking at linear numbers, we're looking at averages. What we're not looking at is distribution curves, your sort of bell curves and your probabilities of successful outcomes.
The volatility around those.
That's a different discussion. We did run some numbers on that as well, and they are fairly close. I think the question that these numbers start answering for us is, on average, what is the position I'm going to be in? Also, we must understand about pots the following things. Firstly, when it comes to pots and when it comes to bridges, the only difference is that my bridge is capital up front that I'm going to use up over a 2-year period. So for 2 years, whether I be in cash or whether I be in a guaranteed strategy, that's sort of derivative based, after 2 years, there's nothing left, and I'm drawing money from my core strategy.
On that note, I hit pause, and we're going to continue this conversation right after the short break. Don't go anywhere.